cash is a risky asset. I think so many people think if I go to cash, I'm going to be safe because it's much less volatile. But please realize in this environment of producing a lot more cash, the real returns go down. It's a seductive asset because, let's say, relative to inflation, you might get taxed 7% a year. That's a huge amount of money over time, but it's a subtle tax. So first, watch that. Then this is a study that I've been doing, and then I decided to share it with people because I think it's so important. A number of years ago, first with 2008, we got into a monetary situation, of course, where we're printing money, creating a lot of debt, and monetizing it. And that led me to realize that there are three big things that are going on in the world that are dominant. And then COVID came along. Those three forces are, first, the long-term debt and monetary cycle, which I mean creating a lot of debt, monetizing it, and the implications of that, which reverberate through the system in terms of all the markets and everything. The second is this conflict, this polarization, this wealth gap, and how we're at each other's throats. And I looked at the wealth gap, and I looked at a lot of measures of conflict going back in time, and I found that they were in the 1930 to 45 period. The printing of money, as I described, and debt monetization was also in the 1930 to 45 period. And the third big influence is the rise of China, so the rise of a great power, challenging an existing great power, the United States. And that has enormous implications. As an investor, I think, what are the relative appeals of the markets? It has a lot of implications. It's not just a trade war. So the markets and everything were reverberating the trade war, the technology war, the geopolitical war in Taiwan and the South China Seas, and then also the capital war. We're seeing that emerge. So those three factors required me to then go back in history. I wanted to study the rises and declines of reserve currency empires. So I needed to go back far enough that I would have a few. So I had to go back 500 years so I could see the rise and decline of the Dutch Empire and its reserve currency, the rise and decline of the British Empire and its reserve currency, the rise and beginning of decline for the United States and its reserve currency, and China. It is really concerning. It's even more concerning when I went back to find the 500 years and the times that repeated over and over again. And what I found was there's a cycle. There's a big cycle. You know, you start a new world order. In 1945, we began a world order after the war. They decided how the world would be divided. They created the dollar as the world's reserve currency and so on. And then, because there's so much fighting, and then you've established a power that is a dominant power, you have a period of peace and prosperity. And then that gets extrapolated, and it leads to more debt. Fear of bad times diminishes. Opportunities of borrowing and getting in debt, particularly if you have a reserve currency, because the world wants to save in that reserve currency. And that gets the country deeper and deeper in debt. And so you have those debt increases and you have bubbles, but you have prosperity. And bubbles are really fun. They're really enjoyable. They're great. But then you get to the point that there is a limitation to that. And those limitations become apparent when the central bank can't easily produce money and credit. That starts when you hit zero interest rates, because then you can't do it the same. Monetary policy one is interest rate monetary policy. When that doesn't work anymore, you go to the next type of monetary policy, which is printing money and buying financial assets. But that purchases of financial assets and other things widen the wealth gap, because those who have financial assets do better than those who don't have financial assets. And you have a wider and wider wealth gap. And when you have that wider wealth gap, and then you have another downturn in an economy, that's a formula for a lot of conflict. And so that's what we see. So what does a central bank then do? If it taxes, it takes money out of the economy, that's not good. It's a problem. Mm-hmm. And if it cuts expenses, that's a problem. So the central bank always, through history, this goes back literally thousands of years, the central bank or the entity that controls money then prints more money. Think of it, we got all those checks in the mail, and we needed to get all those checks in the mail, but you can't take it away from anybody. So where does it come from, and what are the implications? So that happens for logical reasons. And it often happens at the same time as there's a rising power externally as a competitor, which is a challenge in that environment. So yes, it's one of those times. And I think people are not aware of it, because I learned from my experiences that many things that happened in my lifetime that surprised me never happened in my lifetime before, but they happened many times before in history. And that if I would go back in history, I could see that. The first time that happened was in 1971. I was clerking on the floor of the New York Stock Exchange, and Richard Nixon gets in front of the camera and says, "We're not going to give you the gold," and devalues the dollar. And I walked on the floor of the stock exchange. I figured there was a big crisis. And I walked on the floor of the stock exchange, and the stock market was up 4%, which was the most in a couple of decades. And I said, wow, that's surprising. And then I found out that Roosevelt did the exact same thing on March 5th, 1933. And what was done in those two times is the same thing that was done on April 9th when the federal government and the Federal Reserve decided to produce a lot more money and credit. So yes, you need these perspectives, and I want to pass that along. Monetary policy 3, which is now what we are seeing and what is needed, is the production of that debt through government borrowing and the government direction of those checks to those who need it most. That's what we just saw. And that being then monetized by the central banks. And so we're in a new era, of monetary policy 3, as I call it. Monetary policy 3 will mean that the free market will play a much less role in determining those capital market flows, that the government, as we come into the future, will be thinking, how do I get that money to those who need it the most? So it'll be a highly political decision, much more political than it was in the past, and that the central bank then will monetize those political decisions. So monetary policy 3 means there's that type of cooperation. So those are the two dimensions of the big change environment. You're going to see much more government influence and direction of where money goes, which will have a big impact on not only the economy, but of markets. You have to watch what they're going to spend their money on, and they have to watch where they're going to get their money from, what taxes and so on means. The government will play a bigger role. And it also means that there'll be much more debt that is monetized.